Hi, and welcome to Arnerich Massena's third quarter 2018 MarketCast. The U.S. stock market closed near a record high in the third quarter. This meant big gains for investors, but also suggests some significant risks are ahead. In today's MarketCast, senior analyst Arthur Coyne will take a look at the economy and the market, and investment advisor Kate Deines will explain what that means for our client portfolios. Thank you for joining us today.
The S&P 500 index just had its best quarter since 2013, and high-yield bonds also performed well, as more than 3/4 of all U.S. companies outperformed their earnings expectations. Other investments, such as bonds and international investments, remained roughly flat during the quarter. Due to the remarkable performance of the U.S. stock market, the U.S. stock market has grown from being 42% of the global stock market in 2009 to being a staggering 55% of the global stock market today. Not only is the U.S. stock market outsized relative to the globe, but several of our companies have also taken a dominant position in the global economy. Apple, Amazon, Microsoft, and Google are 4 of the largest U.S. companies, each with a market capitalization around $1 trillion. This means that each of these companies is equal in valuation to all of the stocks in each of the countries listed here. For example, an investor could buy Apple, or they could buy all of the stocks in Qatar, Chile, and Russia combined. You could buy Amazon, or all Greek and Spanish stocks combined. For investors, the question is, will these trillion-dollar companies be able to continue growing in relative size and value? Or will that slow, perhaps with competition and regulation? In this chart, we see U.S. and international stock performance and valuations. The recent growth spurt in U.S. stock performance means that there's been a divergence between valuation levels of U.S. stocks and international stocks. For instance, U.S. stocks are now trading above their 20-year average price-to-earnings ratio, and they're trading at about a 50% premium to international stocks. Meanwhile, international stocks are trading below their 20-year average. So what's been driving the U.S. bull market, and how much longer will it continue? Monetary policy has likely been a factor. In this chart, the blue area shows the Fed's balance sheet, an extraordinary amount of additional liquidity that the Fed has provided coming out of the 2008 global financial crisis. The green line overlays the growth of U.S. stocks over the past decade. These two track closely until 2017, at which point the Federal Reserve reversed its policy and started to shrink its balance sheet to guard against inflation. The question is whether inflation is such a serious threat that the Fed might tighten monetary policy to the point where it could put the brakes on the stock market. There is a case to be made for inflation being a risk, particularly with a tight labor market, rising oil prices, rising trade tariffs, and late cycle tax reform. Here we plot the New York Fed's underlying inflation gauge, a current measure of inflation, shifted by 16 months against the traditional measure of core CPI. From this chart, it looks like we might be facing an upward trend of inflation at least through the year 2019. If this were to happen, the Federal Reserve could move to a tighter monetary policy, and that could prove challenging for stocks. Here to tell you what this might mean for your portfolio is investment advisor Kate Deines.
Thanks, Arthur. We have a few key tactical views we are actively implementing within client portfolios. And as we move into the fourth quarter, we are continuing to look for undervalued parts of the market. Among stocks, we think some of the most attractive opportunities are in the international part of the market. We are also looking to take advantage of opportunities within value. And given the current bond market environment, we favor lower duration and limiting exposure to lower quality credit. Your advisor, of course, will always keep you informed about specific investment opportunities as they become available. And lastly, we're really excited to announce that we've been working really hard behind the scenes to make some improvements to our quarterly performance reports. We think you'll greatly appreciate some of these enhancements, so please stay tuned for an email to come. A few additional bits of information you may find interesting. As you know, midterm elections are coming up in November. What does this mean for stocks? Well, we've actually found an interesting historical correlation between the number of Senate seats gained by a sitting president's party and the stock market the following year. When the president's party gains more Senate seats, the stock market typically fares better, although there are exceptions. And of course, this is not a prediction and there's really no way to tell the future, but it is a very interesting historical correlation. Please check out our blog post on the topic for a more detailed conversation. Lastly, some stocks have changed categories. The telecommunications sector has been renamed communication services, and a number of stocks will be moved into this category, including giants like Facebook, Google, Netflix, Disney, and Comcast. This restructuring will affect 23 companies worth $2.7 trillion, which is nearly 5% of the entire world's market capitalization. Of course, this won't make any difference in your portfolio or how it's measured, but you may notice the new category and sector breakdowns going forward. For more information, please visit us on the web at arnerichmassena.com. Thank you so much for joining us today.